is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston. The Money Matters Radio Network.
How does your DAV membership benefit you? As a DAV member, in addition to DAV programs and services, members are entitled to a member benefits package, which gives you access to a variety of important programs, products, and services. Also included with your membership is a free subscription to DAV Magazine. For more information, visit davma.org. That's davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Preparing for an Upcoming Retirement. Mike, what kinds of things do people need to look at to know whether or not they can undertake a successful retirement?
Yeah, I mean, first steps first, we talk about your income sources in retirement versus your expenses. And usually the easiest thing today is to look at what are my income sources now, how will they change, and what are my expenses now, and how are they likely to change. On the expense side, oftentimes it's not that big of a change, but I think that's the first starting point before getting into more complicated things such as my investment portfolio, my health insurance situation, or Social Security strategies.
Mike, a lot of times people are concerned about whether they have enough to live all the way through retirement, and so they might delay their retirement significantly. But it's also worth pointing out that sometimes the biggest risk is not retiring early enough, and you might miss out on some retirement years that way.
Yeah, I mean, look, we all do get worried about longevity, and there are plenty of warnings out there in the media about how Social Security or these other things might not keep pace. But man, it sure is devastating to see the opposite one, where you work your whole career, work your tail off, save all this money, and it can impact your health. It can impact all sorts of things. And to not get to enjoy that full retirement because you choose to work longer than you might have needed to is so much more frustrating.
Our guide this month is titled Preparing for an Upcoming Retirement, and there are two ways you can request it. The first is by calling 800-393-4001. The second is by going to ArmstrongAdvisory.com. That phone number again is 800-393-4001, or you can visit ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting DAV5K.Boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker with you. It is the unofficial kickoff of earnings season as 3 of the major U.S. banks reported earnings before the bell. Those banks are JPMorgan, Wells Fargo, and Citigroup Group.
Was JPMorgan some sort of like joke about it being a JIP to bank there, or were you just mispronouncing
I was just mispronouncing their name.
Okay, got it.
So it's actually JPMorgan, Wells Fargo, and Citigroup. And what we have here is that for JPMorgan and Wells Fargo, both of them facing pressure on what's called their net interest income, or NII, N-I-I.
Why would that be, Chuck?
And net interest income is a really simple metric to calculate. It is the difference between the interest that you have to pay out to depositors in the form of, savings accounts and CDs and stuff like
money
that.
markets, etc.
And the interest that you earn on loans that you make. Mortgages, car loans, credit cards,
deposits at the Federal Reserve,
anything else along those lines. So what you saw was that the firm earned $23.1 billion in net interest income for the first 3 months of 2024. I mean, look, that's not bad. That's $300 million a day in net interest income, almost.
Yes.
It's actually up 11% from a year earlier. It still expects to earn about $90 billion from that this year as well. But not quite as favorable as, investors were hoping for. So even though they beat on earnings, even though they, had a pretty good quarter, admittedly, JPMorgan's stock at this very moment is down about 5%, which is more than the rest of the market is down.
So what does this tell me about? I don't think it tells me much about, it tells me a little bit about banks and consumer behavior. What I think it tells me is that very early on last year when banks started failing, depositors flocked to JPMorgan, Wells Fargo,
yes,
Citigroup, and Bank of America, and they did not generally care what those banks were paying them in interest because it was all about a safety move. Rates have continued to move up during that period of time, and the divergence between what I assume you can make on a deposit at JPMorgan Chase, which is probably not very much money, and what you can get paid by, for instance, putting your money in a money market at New York Community Bank Corp, which
I just
is now
went to
paying.
Chase's website right now.
Yeah.
And for Chase Savings accounts, the current rate is 0.01%.
That doesn't sound very good.
It's almost nothing. It's not nothing.
There's a little bank that's headquartered down the road in New York called New York Community Bank Corp, which is facing all sorts of liquidity issues.
I was going to say.
But they are offering FDIC-insured deposit accounts paying 5.55% right now, the best in the entire country, according to several reports.
Oh.
And so what I believe is probably happening here is, probably not large businesses saying, hey, yeah, I feel safe enough with New York Community Bank Corp. I'm going to toss all my deposits there. But many investors who were probably quite nervous about bank failure early on and needed their funds at JPMorgan Chase to feel safe are now taking a second look around and either moving those funds to, say, an investment account where they can go do different things with it, like money market mutual funds or treasury loans, or they're going and finding other banks that are willing to pay them more on CDs that might not have the same clout as JPMorgan Chase, Wells Fargo, Citibank, or Bank of America, but that they are certain enough that aren't going to fail, or they're just moving their deposits there under $250,000, which, let's be honest, for 90+% of Americans, that's what we are talking about here. Moving their entire savings to other banks because they know that the federal government still has their back. Remember, even in the case of Silicon Valley Bank failing spectacularly, the FDIC shut them down on a Friday afternoon, and if your deposits were FDIC insured, you had access to them on Monday morning.
Which is how it pretty much always works with bank failures. Like, that's the typical story is, yep, we closed them on a Friday, they reopened with a new name on Monday. Mm-hmm. As long as you're under the limit, you have full access to your money. If you're over the limit, it can take longer. And it often does. In the case of Silicon Valley Bank, I'm not sure how much longer because, when a bunch of wealthy billionaires just keep, hundreds of millions of dollars of corporate money at their bank, hey, they've got some clout and some sway, and so they're able to influence things a little bit.
To be clear, in the case of Silicon Valley Bank, it took a little bit longer. In the next case of a bank failure, there is no promise of any guarantee on the money over $250,000.
No, oftentimes you have to take a significant haircut, and in some cases you are completely wiped out, depending on the particular bank. This net interest income, miss from JPMorgan, not unique to them. Wells Fargo saw net interest income drop as well. They earned $12.2 billion in net interest income for the first 3 months of the year, down 8% from a year earlier, and less than the $12.3 billion expected. And Wells Fargo, I guess the question that I really have to ask of them at this point is kind of the one from Office Space. They bring the consultants in to cut headcount.
What exactly would you say you do here?
That's kind of what it is. I don't know what they do well other than just exist. And in some cases probably have near monopolies on local markets because they've just been there for so long and they're the dominant force in those markets. But I don't really know what they do well. I do know what they do badly, which is have, poor internal controls that have led to a number of major issues over the last decade with the bank. And so I think the piece with Wells Fargo and with a lot of these companies, quite honestly, banks are, especially the big banks, there's not much there in terms of what they can do.
They're regulated into boring.
They're almost utilities. They're not, but they're close. And I say they're not because JPMorgan for the last decade has earned like a 15% annual return, which is not something that you've gotten from many utility stocks. But you kind of look at Wells Fargo in particular and you're like, all right, you got a mortgage business. That's nice. You do some car loans. It's nice. What are you going to do at this point? I mean, what Wells Fargo stock? I mentioned how well JPMorgan's done over the last decade or so. Wells Fargo stock. You take a look at the last 10 years, and if we look just at the price again, I'm stripping out any dividend. Actually, no. Let's do total return. Let's live a little bit here. If we take a look at Wells Fargo stock over the past decade, it's up 57%, including dividends.
Okay.
It's about 5% a year. During a time where the S&P 500 is up 245%.
Got it.
What are you doing as Wells Fargo? Like, how do you break that cycle? I don't really know how you grow out of it as a giant bank at this point.
I think the only hope, I guess, would be more of what we've seen over the last 12 months. And this, to me, is I don't know if it's going to benefit the JP Morgans and Wells Fargos or if there's just going to be more banks that look like JP Morgan and Wells Fargo and compete more directly with them. But you would generally agree with the premise that we probably are going to have fewer banks 5-10 years from now?
Yeah. I don't know how many fewer.
I don't know how many fewer. Maybe it's not as big a consolidation as we had previously thought with the last few banks to fail, but I think that there's going to be fewer. And as we saw with JPMorgan and First Republic, for example, that swallowing of an unhealthy bank, purely just by reputation, kind of immediately makes that bank healthy. And
yes,
in the case of JPMorgan, they made a ton of money on that on that issue because they didn't trust that First Republic could exist. But when those deposits suddenly went to JPMorgan, all of a sudden, oh yeah, this is something that can exist. So to me, that's, I guess, the really only opportunity for a bank like Wells Fargo is, do you get a deal on some failing bank in the next few years because interest rates could be higher for longer, and can you capitalize on that? I would think, by the way, if you are a bank regulator at the Federal Reserve or at the FDIC or the Senate Banking Committee, you're probably looking at the four of them and saying, I don't really want any of these to own any other banks, but I especially don't want Wells Fargo to own any more of these banks, given what they have done to their customers over the last decade.
That's fair. Let's take a quick break here. When we come back, we'll talk about interest rates and their potential impact on equity markets after this.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
Millions of Americans are preparing for retirement, and if you're one of them, making sure you have a solid plan is the key to enjoying your later years. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and I'd like to ask you 2 simple questions. Can you retire, and should you retire? Our new guide is called Preparing for an Upcoming Retirement, and in it, we'll discuss strategies that can help you answer these questions and others so that you can make the right decision for you and your family. There are many different elements to a sound retirement plan, including knowing how much income you'll need to live comfortably, when to take Social Security benefits, and understanding what financial risks might be worth taking. Get your free copy of our new guide, Preparing for an Upcoming Retirement, by calling 800-393-4001, 800-393-4001, or you can request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all 3 and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
The latest news on inflation, the Fed, the economy, and how the markets are reacting every morning, right here on the Financial Exchange Radio Network.
Piece in the Wall Street Journal. Interest rates have investors worried. Profits give them comfort. So this is a theme that I think you're going to start hearing about more and more. And I think it's important to discuss what it is and why it means. And the idea is, hey, you've got interest rates going up. And the last time that interest rates went up, the Fed's not hiking, mind you. It's just longer-term interest rates are moving up because of inflation concerns. But the last time we saw interest rates move up meaningfully was 2022. And in 2022, stocks sucked. They were very, very bad.
Yeah, at their worst, they were off 25% from their high. They finished the year down about 18%. But
tech was one of the worst performing sectors, down, I think, more than like 35%. I mean, like it was just...
Any way you cut it, it was ugly.
It was not good. And so the concern out there, and the question that I keep hearing is, hey, rates are going up. Does that mean that, stocks are going to get whacked as well? And the answer is, not today. Well, actually, today they are because stocks are going down, but rates are going down too today. The answer is not yet, and here's why. Let's say that I am a company, Chuck Corp.
Yes.
And I sell a widget for $100, and inflation's running 2%, and my sales are growing by 2%. I go in the next year, okay, I now sell my product for $102, and I sell 2% more of them. And all else being equal, my earnings are going to grow if I can maintain my margins by about, 3-4%, somewhere in that ballpark. If I now enter into a world where inflation is running 3% and growth is running 3%, remember, my earnings are not inflation adjusted. So as long as I can grow my sales by that rate of growth, and as long as I can grow my pricing by that rate of inflation, great, I can grow my overall top line by 6%. And my bottom by, 4 to 5% probably, and I now have faster earnings growth. So this is one of the ideas that I think we have to kind of wrap our heads around, because ultimately, inflation, let's remember this, at its most basic core, inflation is companies raising prices. If companies raise prices and sell the same amount of stuff, their sales go up. And if they maintain the same margins, their earnings go up.
I haven't brought this one up in a couple of years because this was the big 2022 thing that we were talking about, but I like the example of tobacco companies to kind of explain how this has operated for many of them over the last 3 decades. As you can imagine, cigarette prices have gone through the roof, mainly not because of inflation, mainly because of taxes.
Yeah.
A whole bunch of taxes, sin taxes, have been put on cigarettes. Pretty much every time that pack of Marlboros got more expensive because of a tax increase, the business was able to raise prices by more than just the tax increase, because consumers generally knew that prices were moving up. They didn't generally know by how much the tax increase was, because most people don't dive into new tax legislation in terms of what the per pack price is going to be on cigarettes.
Sure.
And they just assumed, taxes are going up, I have to pay $1.50 more per pack. It was actually just $1.20 in terms of the tax increase, but the company was able to deliver that higher price because the consumer had an expectation for higher prices. That is what you have seen over the last few years. It can probably explain some of the continued increases in inflation that we are seeing, is expectation for further price increases. And companies of all sorts will probably get away with it in 2024 as well, would be my guess.
Again, it comes back to just something very basic. If inflation is companies raising prices, then unless they see a drop-off in sales volume, it's raising their revenue. Mm-hmm. And if it's raising their revenue and maintaining margins, then it's something where, in the short term at least, it's not inherently anything that's bad for stocks. Inflation on its own is not a killer for stocks. It might be bad for
Households.
We might not, like it as households, but it's not inherently bad for stocks. What is bad for stocks is when central banks say, hey, that's too much inflation. We don't want that to be happening anymore. And so as a result, we are going to raise the cost of borrowing, raise the discount rate, basically all these things that we talk about. And that ends up slowing the economy, which A, cuts sales, and B, because sales are going down, companies say, gee, we've got to cut prices in order to, get this merch off our shelves and stuff. Okay, that also cuts margins. It cuts profit, and that's where you see the pain because of inflation. It's because of that slowdown in recession. So when we talk about what we're seeing right now and how it's very, very different from 2022, there are two key components that you have to remember. The first is 2022 is a period of slowing growth overall. The U.S. and world economies were slowing down.
We had 2 quarters in a row of contracting GDP.
And even nominal GDP, like even before inflation, it was slowing down.
Yep.
So growth was slowing, and the Fed and other central banks were like, granted they were kind of slow on this, but they said, yo, inflation too much. And they started hiking interest rates. So you had the
classical caveman Federal Reserve president.
That's how Jay Powell sounds when he's not in front of the microphone.
Mm-hmm. Mm-hmm.
And so you have a slowing economy and central banks hiking interest rates. Today, you don't have a slowing economy. The problem that we have that's causing this inflation, economy's reaccelerating.
Now, go ahead, finish the thought.
I'm not quite there. So you've got A, that's reversed from 2022. And B, like how many rate hikes has the Federal Reserve announced this year?
0.
They're not hiking. The Fed is not hiking. Roger Federer is not in the mountains climbing around anymore. It's a Fed is hiking pun, but it's a completely different situation from 2022. And so at least in the short term, you have conditions where bonds can sell off and equities. Like this is something that's amazing about Wednesday. CPI prints hot. Bonds sell off. The 10-year sells off 20 basis points, which is a freaking massive move in the 10-year rate. S&P 500 is down less than 1%. In 2022, it would have been down 2 to 4% on that kind of move in bonds.
Probably. Yeah.
That's what tells me about what everyone's looking at here in terms of equity market strength.
Now, I want to make this point quickly, however. The stock market in the long term might be primarily correlated and derived by how much companies earn. In the short term, it's driven by stories and narratives, is kind of one of my takeaways. And the narrative going into this year was that rates are going to get cut, and they're going to get cut fast. And that corporate earnings are going to grow. And what a great economy, what a great stock market to be investing in if you've got rates coming down and profits growing. Half of that equation has disappeared over the last month.
But it's been replaced by another one, which is that the Fed's going to allow higher overall growth this year than they previously were indicating. Because what the Fed said in March with their summary of economic projections, hey, real GDP growth is going to be 0.7% above what we thought it was before.
Yep. Inflation
is going to be 0.2% above what it was going to be before. And we're not changing our policy. They are allowing faster growth. That they told us this.
Yep.
And if they're going to, I always say, look, you got to pay attention to what people do, not what people say. But what they are doing is following that playbook. How many Federal Reserve officials have come out and said, you know what, in light of this recent data, we've got to hike?
0.
None. They're not hiking. Not yet. Let's take a quick break. Wall Street Watch is next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
If you're thinking seriously about retirement, now is the time to build a sound plan that will help you enjoy your later years. This is Mike Armstrong from the Armstrong Advisory Group, and if you're one of the millions of Americans at or nearing retirement age, it's important to understand how to develop this plan, and our new monthly guide may help. In it, we discuss strategies to prepare for an upcoming retirement. We'll walk you through the process of putting together a retirement income strategy, exploring your healthcare options, and managing potential financial risks. There's also the crucial issue of maximizing your Social Security benefits. Call our office today at 800-393-4001 and get your copy of this new free guide, Preparing for an Upcoming Retirement. That number again is 800-393-4001, or you can request it from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
If you served in the Marine Corps, by now you know about the contaminated water problem at Camp Lejeune. If you were stationed or worked at Camp Lejeune from 1953 to 1987, you probably have a lot of questions. We have some answers. You could be entitled to compensation. Billions of dollars are being allocated to pay for damages to anyone stationed at Camp Lejeune during that time. Unfortunately, it appears that officials may have known the contaminated water problem existed and did little to protect their men. The Semper Fi code was not honored. If you or someone in your family has developed a serious illness, including various forms of cancer, call this Camp Lejeune legal support line right now. You can't turn back the clock and change what happened, but you can certainly call right now and learn your rights as a Marine. Here's the number.
800-477-1736. 800-477-1736. That's 800-477-1736. Paid for by Legal Alert Line.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, how can you ensure that your kids' inheritance can be protected from future divorces?
Well, estate planning, as you know, does things like avoid probate, protect assets from nursing homes, and reduce taxes. But you know what? The family behind the estate plan can be more important. And so the trusts live on after you die, and you can have language in there that divides the assets to the children, but doesn't just pay it out, right? It holds it in trust for them and allows them to be trustee, but just not take it. In order to get it, they have an independent trustee that can say yes or no. And that way, by not owning the asset, if they get divorced down the line after you're dead and the other side says, hey, I want half of what's in that trust, you're going to say, that's great, but you have to ask the independent trustee. So it's now not going to be available to you. And more than just the ability to say no, it's the fact that you don't own it. So if you don't own it, it's not a marital asset to begin with, so it should not be even subject to the divorce. So learning how your trust works after you die can oftentimes be more important than when you're living, and it does more for you after you die than when you're living sometimes.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide that will help you determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are selling off a bit today as first quarter corporate earnings season officially launched this morning with several major banks reporting. At the moment, the Dow is down by over 0.75% or 306 points. S&P 500 is down over 0.75% or 44 points, and the Nasdaq is down just over 1% or 176 points. Russell 2000 off by over 1% as well. 10-year Treasury down by 7 basis points, now at 4.49%, and crude oil is up nearly 3% higher today, trading at $87.40 a barrel. Both JPMorgan and Wells Fargo beat first quarter earnings and revenue expectations. Wells Fargo reported a decline in net interest income, while JPMorgan said its net interest income could be shorter than estimates this year. JPMorgan shares down by 5%, while Wells Fargo stock is flat. Citigroup beat revenue forecast, sending that stock down by about 0.5%, and BlackRock shares are down by about 1% after also beating on earnings and revenue expectations. Outside of bank earnings, chip makers including AMD, Intel, and Micron Technology are garnering attention after the Wall Street Journal reported that China directed its largest telecom carriers to phase out foreign processors earlier this year. All three stocks are down by about 3%. Meanwhile, global life shares are seeing volatility after the insurer's stock was targeted by short seller Fuzzy Panda Research. After its plunge of about 50% yesterday, global life stock is rebounding by about 16% today. Immobilized shares are down by about 3% after the autonomous vehicle tech company was upgraded by Wolf Research to outperform from peer perform, saying that after a steep decline to begin the year, much of the stock's downside risk is behind it. I'm Tucker Silva, and that's Wall Street Watch.
Piece in the Wall Street Journal talking about mortgage rates moving back up. At the beginning of the year, there was this optimism that you'd see the Fed start to cut rates sometime, probably in the first or second quarter. We didn't share that optimism, but markets were hoping for it, and obviously a lot of home buyers were too. And now what you're seeing is that rate cuts have continued to be pushed out. And according to Mortgage News Daily, the average 30-year fixed-rate mortgage nationally is back up to 7.37%. And this is causing an awful lot of people who may have been in the market for homes this spring to reconsider. That's the noise that is being made by this piece in the Wall Street Journal.
Do you agree, Chuck?
No, I don't. And here's why I don't. Is because there is a human man by the name of Mike Simonson. And Mike is one of my favorite people for reading about the housing market because he works for Housing Wire, and his company, I think, was actually acquired by them a couple of years ago. And he publishes some great data on the single-family housing market. And this is as of Monday's update from Mr. Simonson. Inventory levels right now are 25% higher than this time last year. So you're 25. We now have 513,000 single-family homes for sale in the U.S. That's up from about 400,000 at this time last year.
That's substantial. I know that that's still probably half of what a market pre-COVID looked like.
Yeah, pre-COVID we were running like 850 to 900 right now.
Okay. So substantially lower than pre-COVID, but 25% increase in inventory is a big number.
Yes. In terms of what we are seeing as far as sales growth, okay, it's not that high yet, but it's increasing. Year to date, we have seen about 8% more sales than this time last year. So higher inventory is leading to higher sales. And in fact, homes under contract recently, in the week before Easter, because you have to unskew this because Easter fell a week earlier this year than last year, and no one buys a home during Easter week. So not no one, but
few people.
Lots of people don't. If you look at the most recent week and compare newly signed contracts, they're up 18% year over year. And for the first quarter as a whole, the first 14 weeks of the year, new contracts are up 12% year over year. So this piece that's saying, hey, you know, the higher rates are causing more people to stay put, maybe it's causing people on the margins to stay put, but overall, the trend that you're seeing this year is that higher inventory levels are leading to higher overall sales levels. But prices are just 2% above the peak in 2022 now, and you're starting to see prices rolling over a little bit compared to last year because of higher rates.
So do you have pricing levels this time last year?
Yes, they're up 5.7%, but again, it's skewed because of Easter and everything. If these prices that we've seen recently continue for another couple weeks, you're in line with last year.
Okay. For
pending sales. So the message that I am conveying here is that as a whole, as a, an aggregate unit of humanity, more people are buying homes this year than last year.
How about let's focus just in the United States in the aggregate level?
That's what as an aggregate, as a bunch of aggregated United Statesians, Americans is the more common term. We are buying more homes this year than last year, and that is directly at odds with what this piece is saying.
Yeah, I mean, not directly at odds with the title of the article, but the facts in the article are talking about and interviewing a very small number of families who have given up and have said, no, instead I'm going to renovate my existing home. And that definitely is happening too, and I can't say that I wouldn't do the same in their shoes because I have a 3.25% actually, forget about that. Not that I'm looking to move anyway, but I am in the middle of a bunch of renovations of my home because I have a 3.25% mortgage and I don't want to move anywhere. And there are probably a lot of people in that boat. But if this article that we're reading from the Wall Street Journal were correct, then prices would be down. If there is such a dry up of buyers, then they're getting used to these mortgage rates, I think is the answer.
So I think prices will be down by the end of the year.
You brought that up, yep.
But I think that sales will be up.
Yeah.
Because that's how you clear this market. And ultimately, that's where I think we're going because remember, each year that you go, Mike, how many years ago did you take out that mortgage?
Let's see.
3 or 4?
End of 19. What's that put it?
5 years.
Yeah.
Bad example for you, but let's say that you're someone who took that mortgage out in 1996. Okay, in 2 years, you're mortgage free. You look at that and you say, okay, I don't have this thing tying me down anymore. Like I don't have this stream of free money. I'm going to move. Or you get the 5 Ds that we can never remember? Death, divorce, diapers, downsizing. Diamonds.
Got them.
And Dodge.
Those things happen. And you can put it off for, as long as you want, but eventually you say, okay, we got to bite the bullet and do this.
Yeah.
Now, what I will say is, look, if mortgage rates were lower, if they were floating around 6 right now instead of 7.3, sales growth wouldn't be running 12 to 15% above last year. It'd be running 25 to 30% above last year. Inventories would not be running 25% above last year. They'd be running 40% above last year.
Yeah, it'd be a lot more coming to market.
That's where I'm going with this because, again, you can put this stuff off, and a lot of people are forced to because of where mortgage rates are. But every year that you go forward, there are more people who say, yeah, this makes economic sense to me as well, and they've been delaying for the last couple of years anyways. There are people who did their delay 2 years ago and are now ready to buy now.
Yeah, and renting over the last couple of years comparatively hasn't looked all that bad. There's another piece, I think this one's, Connor Sen from Bloomberg, saying that rents have moderated over the last year or so, but a lot of inventory came onto the market nationwide, and that might not be happening in the future. And so that could be another pushing force to get more buyers into this market as well, saying, rent stayed pretty steady over the last year and a half. I might have gotten a slight increase, but I've been pretty comfortable with it. You get back to a, 3 to 6% annual rent increase in some areas of the country, and that might be pushing you into the buyer's market as well. I don't... Connor's piece is interesting to me. I don't really have any data that I think can properly explain what level of inventory of apartments are going to come onto the market over the last few years, but he does point out that the first quarter of 2024 was the strongest for net apartment absorption since the 2021 pandemic-related boom. So presumably the number of new built units that have been coming online over the last few years won't continue forever.
Let's take a quick break. When we return, we're talking China and, another Boeing story after this.
Business and financial news affecting the markets and your wallet. We've got it all straight from Wall Street right here on the Financial Exchange Radio Network.
Thanks to dedicated members across the nation, the DAV programs are far-reaching and the personal rewards fulfilling. Our members are diverse in their interest, which is what has made the DAV so successful. Foremost in our hearts is the goal of assuring benefit entitlement and compassion for our disabled veterans. For more information, visit davma.org. That's davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Have you saved enough for retirement? This is Mike Armstrong from the Armstrong Advisory Group. The advisors at our firm have 150 years of combined experience in the financial services sector, and they all work together to help you develop a unique financial plan that offers investment management, financial planning, tax strategies, and retirement planning. It's our goal to help you position your assets and give you peace of mind. Having a solid retirement strategy and investment plan becomes more important as you age, so visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Just click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us develop a plan to help you secure your financial future. Again, that's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Leaving assets to your beneficiaries is a critical piece of any estate plan. Cushing & Dolan has written a new guide that may help you avoid unnecessary mistakes that can cost you dearly in the long run and ensure that your assets are protected for generations to come. An example? The federal estate tax exemption has increased by nearly $1 million from 2023. That could lead to a larger inheritance for your family members. There are several strategies in this new guide that will help you learn how to make the right decisions about your distributions at the right time. Cushing & Dolan have been helping New England families for more than 30 years. Let them help you too. Call 866-848-5699 and get their brand new guide called How to Leave Assets to Your Beneficiaries. That number again is 866-848-5699. Or you can request the guide online by visiting legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Miss any of the show? The Financial Exchange Show podcast is available on Apple, Spotify, and iHeartRadio. Hit the subscribe button and leave us a 5-star review. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. Visit the U.S. Virgin Islands and enjoy your next incredible vacation. Explore St. Croix, St. Thomas, or St. John and enjoy pristine beaches, world-class dining, and fall naturally in rhythm with the heartbeat of the islands. There's no passport required or money to exchange. Go to visitusvi.com and book your trip today. That's visitusvi.com.
Piece in CNBC talking about why car insurance costs are going up so much, and it's pretty straightforward. We are having more accidents. Those accidents are more expensive to fix because cars have more, chips and sensors and stuff like that in them than they ever did before. And You are also, as a result, seeing a higher percentage of cars being totaled, which results in higher insurance payouts as well. And insurance companies had a very bad couple of years trying to price this stuff, and now are trying to price it so that they don't lose millions or in some cases billions of dollars on auto policies again.
Yeah, so as we are seeing in other areas of the market, like homeowners insurance, these rates are climbing dramatically, albeit for slightly different reasons. Some of the increase in homeowners insurance is due to the cost to repair a home. A lot of it is also due to the increasing, areas of natural disaster in some parts of the country, which is likely not hitting the auto insurance piece as much. But this general story of inflation, I think, is a good reminder that I still, believe it or not, see when talking to people about their own financial plans, which is, hey, I've set this whole thing up and I've figured out that I can generate about $30,000 a year from these CDs or these bonds or these life insurance policies that I have. And at $30,000, I'm good to go for life. I feel very secure. I don't even need to take a bunch of, risk in the stock market or, risk in real estate or something like that to generate extra return, because look at this, I'm all set. If the last 3 years has not woken you up to the fact that you are going to face higher prices in retirement, now is the time to let this happen. I know that it's somewhat easier to control costs as a retiree compared to maybe somebody with a young family. Maybe you can delay car purchases, for example. But everybody that is retired right now who is on any prescription drug or has had to make a home repair or who has had to hire a landscaper, even outside of the normal costs of aging, because forget about a nursing home or that type of stuff, but even just the cost of aging, hey, I can't mow my lawn anymore, I can't clean my gutters anymore. If you are not factoring in these almost always occurring price increases that happen for retirees into your financial plan, I'm telling you now, you're doing yourself a disservice when building it. I've seen it myself, and it can lead to really uncomfortable conversations at some point in time. If you have questions along these lines and you're trying to figure out just how much income you are going to need from your nest egg to live comfortably in retirement, please give us a call at the Armstrong Advisory Group. The phone number is 800-393-4001. We've also got a lot of great resources on our website at armstrongadvisory.com. You're able to book an appointment with one of our people from there. But again, the phone number to talk to a real live human being at the Armstrong Advisory Group is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
I have a quick question just about cars before we go further.
Yes.
This piece mentions, I'll quote here, that instead of having to replace a plastic or steel bumper on many vehicles, a simple fender bender can now damage cameras, proximity sensors, and varying other technologies used for newer safety features and tools such as cruise control, parking, and emergency braking. So I've thought about this. Now, I'm sure that there's someone who actually works with this technology that can tell me why I'm dumb. But why can't you just put the sensor somewhere else on the vehicle and, in your algorithm that tells it what's going on, just say, hey, add 4 feet because we placed this on the windshield, not on the front bumper.
How are you supposed to sell your new bumpers?
I'm just saying.
If the car doesn't want it.
Well, so
under the license plate, maybe, or
no. Let's say that you have a sensor.
The bumper is the closest to point of impact.
Yes,
right.
But
so
you don't need to be. I'll give you an example. My eyes don't need to be situated at the very frontmost part of the car to know that there's something in front of me. They adjust. They know that I'm sitting in the middle of the car. Mm-hmm. Likewise, you can program cameras to be able to, and other sensors to be able to say, hey, if I have the camera on the roof of the car, as an example, it is 6 feet from the front. Start sounding the proximity alarm when you detect something 7 feet in front of you.
Well, that sounds like something that will cost them more money, though.
Why?
That's your answer.
No, it's just a math equation.
No, because it's a sensor. It's the nearest point of impact. It's as simple as that.
But does it cost more to put it further away?
I'm sure it does. That's why they don't do it.
No. I go back to my initial theory. You put it on the bumper and somebody gets in a car crash, now I get to sell a new bumper.
Well, you get to sell a new bumper if there's a car crash anyways.
Yeah,
now
but not with a sensor with a bunch of high margin items in it.
So someone's got to solve this because it's just dumb, quite honestly. You shouldn't put expensive stuff where little minor things can happen that damage the expensive stuff. That's why you don't put breakable lamps in front of toddlers, is because it's expected that they will damage them. Likewise, you don't put expensive sensors right in the bumpers of cars, in my opinion. Now, again, I'm sure that there's someone very smart who's going to be like, Chuck, it doesn't work like that. The sensors have to be, close because of the radio frequencies they use or how they work, blah, blah.
That's what I think it is.
No, you don't.
It's got to be something. It's as simple as point of impact. You're overthinking it.
I don't know, because I look at these Waymo cars that are riding around in Arizona and stuff.
Everything's on the roof.
They got a giant brain on the roof. Yeah. Like they actually have a human brain on the roof.
Costs more money.
Well, no, the self-driving stuff costs more money. The fact that it's on the roof, I don't know that costs more. I think they put it there so that if they bumped into something, they didn't destroy all the sensors.
Why can't they just make the whole plane out of the black box?
The obvious solution is
just make the whole car a sensor, man.
Is just to make the car out of Nerf. How has Nerf not gotten into making cars? I get it. The problem would be...
You just blow away.
Well, no, the real problem is that it rains, and now you're driving a sponge. It's a real problem for your fuel economy in that situation because the weight of the car doubles instantly.
I don't like that I can't even buy a car without all these sensors these days. Right? Like
it's kind of like how you can't buy a TV without voice control.
When I was a 16-year-old, we went to go...
Oh, God, we're getting so old now that
buy a new car. And I had the option for a manual with manual windows and manual locks, and that was a very cost-effective car.
This is why when people complain about the price of cars, I say it's not the price of cars; it's what we're demanding from them.
Yeah.
If you didn't want your stupid panoramic roof that you can't use because you're driving and you're not looking up while you're driving, your car would be cheaper.
Yeah.
If you wanted manual windows and no power seats,
I got manual seats.
Exactly. Yeah. You can buy cars for cheap if you don't want the expensive stuff.
Who needs power steering anyways,
Who needs a steering wheel? Just go straight. Quick break. We'll be back with more fun insights after this. Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Preparing for an Upcoming Retirement. Mike, what are some of the things that can derail a retirement that otherwise would be going fine?
I mean, there's all sorts of items. Certainly, a pension going bust or Social Security getting reduced, people worry about. Certainly, we all worry about market volatility and the risks there or inflation. But one of the ones that I think people almost intentionally avoid is the risk of increased healthcare costs. I think we're familiar with Medicare costs and things along those lines. But the portion of Americans who will face some sort of heavy end-of-life care and the costs associated with it, it's a big chunk of Americans, and gosh, it's such a taboo issue that we hate talking about and being transparent about. And so you really have to tackle that one and be straightforward with the potential risk.
It seems to me that just doing some stress testing with some actual numbers can make a big difference in determining whether or not that can cause a problem for you.
Yeah, most certainly. But the costs of things like nursing homes or assisted living facilities are so frightening to people and almost unfathomable in terms of total cost that we just choose to stick our head in the sand sometimes. And that's not necessarily the wrong approach to things like market volatility. But when it comes to planning out your future financial success, putting your head in the sand is a losing strategy.
Our guide this month is titled Preparing for an Upcoming Retirement, and there are two different ways that you can request it. The first is by calling 800-393-4001. The second is by visiting ArmstrongAdvisory.com. That phone number again is 800-393-4001, or you can visit ArmstrongAdvisory.com. The
proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Are you retired like me and you just found out you owe the IRS a ton of money? Well, what would your life be like if they took your retirement savings away from you? They can do it and your property. If you owe the IRS back taxes or you haven't filed in a while, the Tax Relief Line is here to help you. They can stop the IRS from taking your retirement savings. If you qualify, you could have your tax bill reduced to zero. That's right. If you're retired and you owe the IRS a lot in back taxes, you could have your entire tax bill reduced to zero due. The IRS has now hired thousands of new employees, so they're ready to come after you. Don't let them take your retirement savings or property. Make this free call now.
800-251-2153. 800-251-2153. 800-251-2153. That's 800-251-2153.
This is the Money Matters Radio Network. WBNW 1120 AM and W275CM FM. Concord, Boston. The Money Matters Radio Network.
Do you use the expensive blue or yellow pills to charge your sex life? Are you thinking about it? What if we can promise you the same results for less than $3 a pill? If you're paying $20 a pill for the other pills, you're getting taken to the cleaners. Our pills deliver the exact same results for less than $3. You'll save more than $16 a pill for the same results. And right now, radio callers will get 44 blue or yellow pills for $120 with free discreet shipping. You can save more than $700 off pharmacy prices. Charge your sex life now and save a ton of money. Call now and get your 44 pills and save over $700 and qualify for free shipping. Stop overpaying and call right now.
Paid for by Steel Man Pills. 800-475-8547. 800-475-8547. 800-475-8547. That's 800-475-8547.
If you served in the Marine Corps, by now you know about the contaminated water problem at Camp Lejeune. If you were stationed or worked at Camp Lejeune from 1953 to 1987, you probably have a lot of questions. We have some answers. You could be entitled to compensation. Billions of dollars are being allocated to pay for damages to anyone stationed at Camp Lejeune during that time. Unfortunately, it appears that officials may have known the contaminated water problem existed and did little to protect their men. The Semper Fi Code was not honored. If you or someone in your family has developed a serious illness, including various forms of cancer, call this Camp Lejeune legal support line right now. You can't turn back the clock and change what happened, but you can certainly call right now and learn your rights as a Marine. Here's the number.
800-477-1736. 800-477-1736. That's 800-477-1736. Paid for by Legal Alert Line.
Leaving assets to your beneficiaries is a critical piece of any estate plan. Cushing & Dolan has written a new guide that may help you avoid unnecessary mistakes that can cost you dearly in the long run and ensure that your assets are protected for generations to come. An example? The federal estate tax exemption has increased by nearly $1 million from 2023. That could lead to a larger inheritance for your family members. There are several strategies in this new guide that will help you learn how to make the right decisions about your distributions at the right time. Cushing & Dolan have been helping New England families for more than 30 years. Let them help you too. Call 866-848-5699 and get their brand new guide called How to Leave Assets to Your Beneficiaries. That number again is 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com JPMorgan.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to ArmstrongAdvisory.com and let us help you secure your financial future. That's ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting DAV5K.Boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker with you as we kick off the 11 o'clock hour here, and we've got markets selling off today with the Dow off 349 points. The S&P is down 54 points, and the NASDAQ down 218 points, so anywhere from about a 1 to 1.33% dip in your major U.S. indices. 10-year Treasury is down 7.5 basis points to 4.5%, reversing some of the move from earlier this week. And we've got oil moving up $2.30 a barrel to $87.32. This on, I think, both of those moves, quite honestly, on the back of Israel stating, or the Israeli government stating, countries can't say anything, people from the countries can indeed say them. The Israeli government saying that they are preparing for a potential direct attack from Iran as soon as this weekend. Along those lines, you've also got gold now up $69.70 an ounce to $24.42. Gold has been absolutely ripping for the last, 6 weeks or so. Basically, ever since the start of March, it has just been absolutely cranking here, and now is up almost, actually more than $400 an ounce over that time span. And that's kind of what's going on in major markets here.
Do you want to talk about gold for a moment?
I mean, I can talk about gold all day if you want.
So
it's shiny. It conducts well.
Costco's making a killing on selling bars.
What are they selling? Is it $200 million a year or $200 million a month?
I hope it's
Those
not
are
a
very
month.
different.
They are. I was talking to Jim Polito this morning, and certainly we were talking about
$200 million in gold and silver a month.
Dear God,
they're selling $2.5 billion in gold and silver a year at Costco. Must be why the lines are so long.
So we were talking about it, and he brought up what is a very common, in my opinion, misconception that gold is this great inflation hedge, and I countered that in 2022, the year in which we experienced the worst inflation that we have in 4 decades, gold was basically flat for the year.
Yes.
moved. I think it ended up slightly, maybe single digits percentage points, while inflation was up again, the worst we've had in 4 decades. Is there any period other than the 1970s when we depegged from the gold standard that gold has actually been a successful inflation hedge, or is it a hedge against something else, or is it not a hedge against anything that I can think of?
Well, I think it's important to contextualize the environments where gold typically performs well and talk a little bit about what those are, because it's not just inflation, and you hit on that with 2022. Where gold typically performs strongly, and this could be over a day, a month, a year, a decade. And again, you have examples in multiple currencies because gold doesn't have to just be priced in dollars. You can price it in anything. Over the last, again, if you want just an example of this, hang on, let me make sure that I have my time period correct on this. Here we go. Over the last 5 years, in dollar-denominated terms, gold's up 84%. But if you're in Japan, you bought gold, you're up 151% compared to the yen. So it varies based on the currency you're comparing it to. But the point that matters is when it comes to gold and its performance, one of the strongest correlations that you see is to what we call real interest rates. And that doesn't mean that any interest rates are fake, because none of them are, but rather real interest rates are interest rates net of inflation. So if I have the Fed funds rate at 5.5% right now and inflation's running at 3.8%, the real interest rate is 1.7%. Gold tends to perform at its best when real interest rates are lower. So if you have a case like 2022 where inflation is high, but real interest rates are rising because the Fed is hiking, as quickly as it could, not as quickly as it could, but as quickly as they did, you end up in a situation where even though there's high inflation, gold struggles in a year like that because real interest rates are going more towards the positive side of the ledger. They were still negative, but they were getting closer to positive. And so in an environment like this, let's talk about what's happening. Inflation is accelerating in the last 3 months. Is the Fed hiking interest rates? No. So real interest rates are coming down. Now, this is also a great dovetail into something that I want to circle back on, because I remember there were a number of pieces that were published in the fall, and we talked about them at the time because we said, look, this is possible, but it doesn't really meet the eye test. Do you remember the pieces that were arguing that because inflation had fallen, the Federal Reserve was tightening monetary policy because it was simply maintaining interest rates, and the gap between rates and inflation was larger?
Indeed.
Is anyone right now in the last 3 months saying, hey, the Fed is loosening policy because inflation has accelerated? No, because those people were wishing for interest rate cuts,
right? And
now they're silent because it was not really a great theory. I said, look, there could be some legitimacy to this at the time, but I didn't really think it was robust enough to be able to do anything conclusively. But all those people who were saying, hey, the Fed should be cutting because inflation's coming down and now their policy's getting tighter,
they're behind the 8 ball on cutting.
Is there anyone now, or any of those same people saying, hey, inflation's accelerated, the Fed should really hike interest rates?
Got this bias.
Because they were not serious people. It's one of my favorite lines, actually, from Succession. They're just not serious people.
You're not serious people.
I wish I could. That was more Sean Connery than what's his name?
Damn kids.
Yes, that was very Sean Connery. But we can't just say that all people from islands off the coast of Europe are have the same accent. It's very different. It's actually even within England, it's basically 5 different accents, maybe even 6.
I'll workshop it.
Yeah, well, during the break we can see what we can do.
Come back
there.
to us.
But where I'm going with this on gold is the reason that you have gold absolutely ripping right now is that inflation's going up and the Fed's saying it's fine.
Not going to do anything about it.
The Fed's like, no, we're not changing our plan.
Yeah.
And that's why gold is now up $72.80 today. Even more. It's up more than 3% today. When's the last time you saw a 3% update for gold? You probably got to go back. Here's where you probably got to go back to.
No, probably
late 2020.
You think so? I bet you've had a few of those updates in gold on, unfortunately, the day that Hamas attacked Israel, for example.
I would go with no on that.
Really?
I'll do a little bit of digging right now, but let me go back to 10.7. No, you did. So on the 13th, a week later, I guess maybe that's probably when Israel started its retaliation. A week later, you had a 3% move then. Other than that, just eyeballing it right now, and again, I'm just looking for
big jumps,
big moves here. I'm not seeing anything except for back in late 2020, which was when, hey, demand started to pick up. That's when we started to see supply chain problems and stuff like that. Inflation wasn't really rising then, but it was the concern that it would start to. And you had, it absolutely ripped in July of 2020 as well. It started the month at about 1,800 and went up almost 15% by August 5th to almost 2,100. So again, you can have short periods of time where it does this. This recent one's, kind of an example of that where, hey, it was basically treading water for 3 months, December, January, February, and now it's gone up 20% in a span of 6 weeks.
Now, why people are buying $300 million a month from Costco?
$200 million a month.
$200 million in gold per month from Costco. It could be price chasing, could be any number of different things, but that to me is just an absolutely wild story. How much gold Costco is selling right now.
But here's the thing that you have to remember: gold is actually one of those assets that, if you look at how it's performed over long time periods, you actually want to reverse the way that people trade gold and stocks. People love to trade in and out of stocks. So they're like, "Ooh, I'm a trader. Look at me go! Like trade in, trade out. That's what people do with stocks. They make those sound effects too.
Yep. The Star Wars.
In fact,
gunshot.
the single best thing that's been proven by most studies when it comes to stocks is, hey, just buy a broad, diversified basket of them and hold them for as long as you can.
Yeah.
Whereas in gold, people say, "Oh, this is my insurance. I'm never going to sell this. I want to hold this forever." And basically all the money in gold is made around really short periods where exactly the phenomenon I'm describing happens, where interest rates are hugely negative, real interest rates, and you make a bunch of money in a short time period and then give it back over, the subsequent decades and stuff like that. Great example of this recently, 2010s. Gold in 2009, before the financial crisis, was it like 700? Went up to 1,900 in 2011 on inflation fears. It didn't get back to 1,900 until 2020. So, there's a ton of money that can be made in short periods with gold, but generally over long periods of time, it's kind of like, well, it hangs out there. It kind of keeps up with inflation. I've heard a great line where the price of gold at any point in time is pretty darn close to a high-end tailored suit. You go back to the 1970s, you get like a personally tailored suit from like a legit tailor, not, a place that's outsourced somewhere.
Sure.
$300-400. Obviously, you can get them, you can get cheap ones now. I'm not saying you have to spend that much now even. But hey, if you want like a professionally, custom tailored, someone doing it up, in Boston or in New York, you're going to spend $2,500 on that suit now.
Mm-hmm.
So like the suit to gold ratio is generally around 1-to-1 is what I've heard. Now again, you don't need to spend anywhere near that much. I am notorious for when it comes to suits. Pop me over to Men's Warehouse or Joseph A. Bank for the 8-for-1 sale, and I'm good to go.
Yeah.
Let's do a quick break here. I'm wearing a freaking sweater today. What am I even talking about? Let's take a quick break here. When we come back, we've got trivia after this.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play The Financial Exchange. This is the Financial Exchange Radio Network. Leaving assets to your beneficiaries is a critical piece of any estate plan. Cushing & Dolan has written a new guide that may help you avoid unnecessary mistakes that can cost you dearly in the long run and ensure that your assets are protected for generations to come. An example? The federal estate tax exemption has increased by nearly $1 million from 2023. That could lead to a larger inheritance for your family members. There are several strategies in this new guide that will help you learn how to make the right decisions about your distributions at the right time. Cushing & Dolan have been helping New England families for more than 30 years. Let them help you too. Call 866-848-5699 and get their brand new guide called How to Leave Assets to Your Beneficiaries. That number again is 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Millions of Americans are preparing for retirement, and if you're one of them, making sure you have a solid plan is the key to enjoying your later years. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and I'd like to ask you two simple questions. Can you retire, and should you retire? Our new guide is called Preparing for an Upcoming Retirement, and in it, we'll discuss strategies that can help you answer these questions and others so that you can make the right decision for you and your family. There are many different elements to a sound retirement plan, including knowing how much income you'll need to live comfortably, when to take Social Security benefits, and understanding what financial risks might be worth taking. Get your free copy of our new guide, Preparing for an Upcoming Retirement, by calling 800-393-4001, 800-393-4001, or you can request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, why can't you just add your kids to your accounts or to your house deed?
Well, you can. It's just not a good idea. So people who do that understand with an account, right? You can put a joint name on the account. Now, that doesn't actually complete the gift because you actually have to take the money out and then the gift is complete. But when you set it up, yeah, the asset would avoid probate. But if something happens to the child, it's going to be, available. Half the asset would be subject to the children's creditor. So you don't want that. And secondly, if you only put one kid on the deed, you've likely disinherited the other kids. So it's not really good planning overall. Whereas if you put the house in the kid's name, now you've actually made a completed gift of half the house and would need to file a gift tax return. Number one. Number two, of course, it's exposed to the child's creditors and, yes, divorces. You could find yourself at some point owning half your house with an ex-in-law. Not sure that's a good way to plan. So please, put together trusts. Don't just throw names on deeds or on bank accounts because, as I always like to say, nothing good comes from giving assets away while you're living.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide that will help you determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
All right, trivia is brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m., including half-price boneless buffalo wings, half-price spinach and artichoke dip, and half-price warm pretzels dipped in beer cheese. Gather with friends any day of the week at Applebee's and say hello to half-price appetizers served late night, because half off is just more fun. Now, that's eating good in the neighborhood. Void where prohibited. Dine in only. Well, today is David Letterman's 77th birthday. Letterman began hosting a late-night talk show in '82 when Late Night with David Letterman debuted on NBC. Letterman's final late-night show aired on May 20th, 2015 on CBS. Letterman's first guest on NBC was also his final guest on CBS. Trivia question today: who was David Letterman's first and final guest on his late-night talk shows? Once again, who was David Letterman's first and final guest on his late-night talk shows? Be the seventh person today to text us at 617-362-1385 with the correct answer. You win a Financial Exchange Show t-shirt and be registered to win a $100 gift card to Applebee's. Be sure to include the keyword Applebee's in your text, so we'll give away that Applebee's gift card in the next segment. 617-362-1385. And the 7th correct response will be our winner. See complete contest rules at financialexchangeshow.com.
Piece from Bloomberg. The U.S. had a chance to lead in chip-making technology and missed it. Why?
An Intel CEO didn't believe in the technology, is what a lot of it comes down to, and wanted to see it tested out in other countries that would have to spend the big bucks, and had a pretty big missed opportunity. I don't think you can blame it all on one item, and this does seem like a bit of a hit piece on the former Intel CEO, but Intel was one of the biggest companies that made an investment in this Dutch firm that we have talked about before, ASML. They make all of the world's fabricators for semiconductors.
Lithography machines are what they're called. They use extreme ultraviolet light. This is actually really cool.
The coolest part about this story is the technology that goes into making these things, bouncing lasers off a bunch of mirrors that can barely have any sort of imperfections on them. So
yes,
that's what I found to be the coolest part of this article.
It's so cool.
But the most disappointing part of this article was that Intel, a famous American business, was one of the single largest investors in this technology. Kind of came up with the theories behind it. Maybe not Intel themselves, but the American universities came up with the ideas behind the technology and then doubted whether or not it would be successful, so did not implement it in the United States and effectively allowed many Asian countries to dramatically surpass us in terms of semiconductor production. Am I misidentifying anything or miscategorizing anything there? Because
that's what's laid out here. I would argue that the problem starts even before that.
Okay.
In that, if you have so much market power tied up in one company like Intel, which for most of the 1990s and 2000s basically allowed AMD to exist just so that they wouldn't get sued by the DOJ for antitrust concerns. Remember, NVIDIA at the time was not even a major chip maker. NVIDIA made graphics cards for computers for the 1990s and 2000s. They didn't make CPUs. They made what are called GPUs. They still do, but they're geared towards AI and everything that you can do there because there's just a ton of power inside them. But you talk about like the biggest chip makers in the 1990s, and it was pretty much Intel and AMD domestically.
Right.
And the only reason Intel allowed AMD a little tiny sliver, like 5% of the market, was so that Intel wouldn't get sued for antitrust concerns. They probably should have been anyways.
Right.
It is a huge failing of ours that because there's no competition, the decision of one company kind of put the entire U.S. chip-making industry behind the 8 ball for decades to come. That's a failing of ours. And we've got to live with that now. So you could have still had, in an alternate universe, Intel says, no, we don't want this. And Chuck's chip maker said, hey, we do. And because you allow for more competition, you end up with a different story being written. That's my take on it.
So, interesting take.
And also that, quite honestly, as people who are supposed to be forward-looking on this, the Department of Defense and other related interested parties should have been on this as well 20 years ago.
So the questions that I have, beyond the lesson learned that it's a lot easier to be at the forefront than trying to make up lost ground on the back end like we are doing right now, much more costly to do what we're doing now than just being at the forefront of this and developing the industry domestically. The other lesson seems to be one that we've talked about, which is monopolies create all sorts of potential problems in misidentifying the next technology, the next up-and-coming technology.
Yeah.
And there are plenty of examples out there that I would be concerned about, probably none bigger than Boeing, but plenty of American companies that you can say the same thing about, that, monopolistic power breeds
complacency.
Yeah. Complacency is the right word there.
Yeah. Along these lines, Apple plans to overhaul its entire Mac line with AI-focused M4 chips. Okay, they're getting the word AI into their chips.
AI probably doesn't even stand for artificial intelligence.
Sent
in
the
this
stock
case.
up 5% yesterday, by the way.
Again, this is where we're starting to get to some really dumb stuff.
Yeah, it's AI washing. We've talked about this. It's the same thing as greenwashing a few years ago.
And here's the other thing. Like, when it comes to AI in your computer, What does the average person need it for? People be like, oh, like you can make videos and you can write faster. How much video making and writing does the average person do these days? Not much.
There are very unique and interesting examples of how artificial intelligence can be created. There are also a whole bunch of lies about artificial intelligence being used to boost stock prices, and that is where the discerning investor needs to beware.
We're also now 3 to 6 months away from a world where we can't trust videos anymore because of how prevalent AI-generated video is going to be. I don't know what the answer is other than just you got to see it in person. Quick break. Trivia answers next.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have debt destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Preparing for an Upcoming Retirement. Mike, what kinds of things do people need to look at to know whether or not they can undertake a successful retirement?
Yeah, I mean, first steps first, we talk about your income sources in retirement versus your expenses. And usually the easiest thing today is to look at what are my income sources now, how will they change, and what are my expenses now, and how are they likely to change. On the expense side, oftentimes it's not that big of a change, but I think that's the first starting point before getting into more complicated things such as my investment portfolio, my health insurance situation, or Social Security strategies.
Mike, a lot of times people are concerned about whether they have enough to live all the way through retirement, and so they might delay their retirement significantly. But it's also worth pointing out that sometimes the biggest risk is not retiring early enough, and you might miss out on some retirement years that way.
Yeah, I mean, look, we all do get worried about longevity, and there are plenty of warnings out there in the media about how Social Security or these other things might not keep pace. But man, it sure is devastating to see the opposite one, where you work your whole career, work your tail off, save all this money, and it can impact your health. It can impact all sorts of things. And to not get to enjoy that full retirement because you choose to work longer than you might have needed to is so much more frustrating.
Our guide this month is titled Preparing for an Upcoming Retirement, and there are two ways you can request it. The first is by calling 800-393-4001. The second is by going to ArmstrongAdvisory.com. That phone number again is 800-393-4001, or you can visit ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
Trivia question today was who was David Letterman's first and final guest on his late night talk shows? That'll be Bill Murray. Bill Murray was his first guest on NBC in '82, and he will go on to make 43 appearances on Letterman's show, and then Murray was the final guest on Letterman's show before the host retired back in 2015. We have two winners to announce today. Winner of the Financial Exchange Show t-shirt was Bob from Chatham, Mass. And the weekly winner of the $100 gift card to Applebee's was David from Braintree, Mass. So congrats to both winners there. And trivia is brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m. because half off is just more fun. Now that's eating good in the neighborhood, void where prohibited, dine in only.
Amazon, their director of global robotics, Stefano LaRiviere, said, and I'll use his quote actually, "It's a myth that technology and robots take out jobs." So pretty much saying, no, robots are not replacing workers. And I think I get what he's trying to say, but you know,
saying that way doesn't actually add up, because 100%. All right.
What?
Get your papers for you. 100%. Robots do and have taken jobs. I think what he is probably trying to say is that the increased productivity created from utilizing, let's just call it automation instead of robots, has grown the overall size of the pie, allowing for more and different jobs down the road. But robots have absolutely taken jobs.
Robots might not take jobs in the aggregate because there's always more work to do, but they may take your job.
Yeah.
And this is kind of the crux of how we have to navigate technological breakthroughs. I use the point all the time that if you look right now, the United States has far fewer agricultural workers than it did 100 years ago. And yet we still eat. We view that as progress, but if you were someone whose job was lost because there's a combine doing it now instead of, you used to have to do that stuff manually or with a horse or whatever, it was a big deal in your lifetime. It's
if you were a worker at JPMorgan Chase whose job was to manually build spreadsheets and calculate numbers for the accounting department, and your job was replaced by the advent of the computer, you lost your job and needed to go find something else. But JPMorgan Chase very likely employs more people than they did. Well, JPMorgan and Chase weren't the same company in the 1960s.
True.
But
I get what
they
you're saying.
employ more people today than they did back then.
Ultimately, here's the other thing. The idea that and again, this is like a big leap, and this is like not realistic, but I just want to contextualize what we're talking about here. If, in theory, you could run the whole world when one person woke up and pushed one button, that's not necessarily a bad thing either. It's just how do you figure out all of the societal implications of what that means. But if we can get so productive that one person can, press a button when they wake up in the morning and the whole world just does what it's supposed to do, that's not a bad thing. The bad thing is, okay, how do we figure out how this works societally then? So these are different things that we need to sort through. But overall, when it comes to progress in technology, the whole thing is always about allowing for more productivity, which means that fewer people are needed for the same work.
And you can make plenty of criticisms about this, right? Like, I think a fair criticism over technological advancement over the last 100 years is that arguably the primary beneficiaries have been at the top.
Right, that's the societal issue that we're talking about, which is the winners and losers issue.
Right, the question is how much, so if the primary winners at the top are taking home a larger percentage of those productivity gains, that means that everybody else's slice of the pie is smaller, but in the aggregate, how much bigger has that pie gotten?
Correct. Those are the things that we have to figure out as humans.
I always like to go back to pie analogies, as you can tell.
We are having pizza for lunch today.
Yeah, that's how I got there.
Yeah.
Beneficiary planning and asset protection go hand in hand, and Cushing & Dolan, the experts in elder law and taxation, can help make your planning process smooth and easy. Simply saying you're leaving everything to your kids isn't as simple as it sounds, especially if they have problems on their own. If you're retired or nearing retirement, it's time to consider the best way to keep your assets in your family while avoiding significant financial consequences down the road. Call Cushing & Dolan right now at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. You'll learn which paths are the safest when it comes to protecting yourself and your children while avoiding unnecessary risks that can cost you dearly in the long run. That number again is 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Should you buy a hybrid car? Here's what you need to know. It's a piece from the Wall Street Journal, and I think there are a few things to actually know if you're considering buying a hybrid car.
Sure.
The first is, well, and again, I know this is kind of basic, but there are probably some people listening who are like, well, what is, how does it actually work? Hybrid car is very simple. It's got a battery in it, often a pretty small one, and it has an internal combustion engine.
Been around for a quarter century now.
The two work together in order to ideally improve fuel efficiency while, still generating enough power to move the vehicle. That's, you don't want a car that doesn't move. And the whole point is, again, that efficiency improvement. There are two types of hybrids that are available today. The first is kind of the traditional model, which is, based on the original Prius, which is there is a very small battery that can't power the car on its own, but helps to assist, the internal combustion engine at times and improve the fuel efficiency of that internal combustion engine.
Can allow the engine to turn off at stop signs or at stoplights, as you see with even non-hybrid cars these days, and at very low speeds, oftentimes power the car at low speeds.
There are also what are known as plug-in hybrids, which have larger batteries that can often power the vehicle for anywhere from 15 to 40 miles on a charge, and then have an internal combustion engine that takes over beyond that, or the two can also work together in some situations as well. In the plug-in hybrid version, and even some of the conventional ones, there are different ways that you can set those engines up to accomplish different things. Toyota, who is the largest producer of hybrids in the world, the Prius, as an example, is built for pure fuel efficiency. Mm-hmm. They also have a version of the Tundra called, I think it's the iForce Max or something like that, which is a hybrid, but the electric motors on the hybrid function at the same time that the internal combustion engine is providing power, and so it gives you broader torque distribution and broader horsepower, so it gives you more power at wider intervals along your conventional revs of the engine. So there's different ways that you can structure it based on what you're trying to do.
Now, hybrids, by and large, a little bit more expensive than gas-powered vehicles. There are two motors that are in the vehicle for a number of reasons. They're going to be more expensive, bigger battery packs, etc. Run 10 to 20% more expensive than their non-hybrid counterparts if they make those. As an example, the CR-V hybrid is about 15% more expensive than the gas-only CR-V, which is, again, cheaper than most comparable all-electric vehicles as well.
Consumer Reports has done an analysis on this, and they say, in general, the average payback period on that extra cost is about 4 years when gas is $3.35 a gallon and you drive 12,000 miles a year. So if you're just going to be buying, if you're one of these people who cycles through cars every 3 to 4 years, it's probably not giving you any cost savings. If you own a car for 8, 9, 10 years or just drive it a ton of miles, yeah, you might get some more, long-term savings over it.
Type of driving here is important too. If you're mainly doing highway mileage, the hybrid does not help you a whole lot, right? If you're driving
Not
a
as
mile
much,
to
yeah.
the highway and then doing your other 11,500 miles a year on the highway, that hybrid engine is going to get a lot less usage and a lot less benefit compared to commuting in and out of a city where you're in stop-and-go traffic frequently.
Let's take a quick break here. When we come back, we're going to be joined by Paul LaMonica from Barron's, and we're talking Netflix when we return.
Miss any of the show? Catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Leaving assets to your beneficiaries is a critical piece of any estate plan. Cushing & Dolan has written a new guide that may help you avoid unnecessary mistakes that can cost you dearly in the long run and ensure that your assets are protected for generations to come. An example? The federal estate tax exemption has increased by nearly $1 million from 2023. That could lead to a larger inheritance for your family members. There are several strategies in this new guide that will help you learn how to make the right decisions about your distributions at the right time. Cushing & Dolan have been helping New England families for more than 30 years. Let them help you too. Call 866-848-5699 and get their brand new guide called How to Leave Assets to Your Beneficiaries. That number again, is 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The Financial Exchange is now available on your Alexa smart speaker. Ask to play the Financial Exchange and catch up on anything you might have missed. This is the Financial Exchange Radio Network.
Ladies and gentlemen, the weekend.
The Financial Exchange has built an incredible partnership with the Disabled American Veterans Department of Massachusetts. We can't wait to take part in this year's DAV 5K, set for Saturday, November 9th at Fort Independence on Castle Island. Registration's now open. You can help our great American heroes by walking, running, or simply making a donation. Your gifts will support services such as the Veteran Advancement Program, which offers permanent and affordable housing opportunities for veterans and their dependents. Learn more at DAV5K.Boston. The DAV 5K Boston is presented by Veterans Development Corporation.
As promised, we're now joined by Paul LaMonica from Barron's, and we are talking Netflix with Paul. Paul, how you doing today?
I'm good, thanks. How are you guys doing?
Doing well. You've got a piece from yesterday. It's titled Netflix Stock Deserves a Place in the Magnificent Seven. Obviously, if you're going to keep it at 7, who are you taking out, Paul?
Yeah, that's a good question. Who do you take out? I mean, Tesla's the biggest laggard this year, so I guess you could start there. But I think the thing that we should be thinking about instead of maybe putting Netflix in the Magnificent Seven is just expand it, and it could be the Exceptional 8 or the Elite 8 for those of us still smarting about our bracket losses in this year's NCAA tournament. Netflix clearly has a lot of momentum right now, and even though we don't talk about the FANGs anymore, it is still one of the hottest stocks out there because of the strong growth in revenue, earnings, and subscribers.
Paul, why is every other streaming company talking about cutting costs and cutting content, and they can't make money and this and that, and Netflix is not?
Yeah, I think that there are a couple of factors at play. I mean, companies like Disney and my former parent, Warner Brothers Discovery, when I worked at CNN, they obviously have Max. I think maybe that there is this sense that companies were throwing too many shows and movies at the wall, and there's just a lot of competition out there. And I think consumers are feeling fatigued. You throw in things like Apple and Amazon with their own offerings, and maybe consumers, that cut the cord now look at their bills and say, okay, I don't have a giant cable bill anymore, but I have 6 or 7 streaming services and I only watch like 1 or 2 regularly. I think Netflix has done a very good job of really coming up with buzzworthy content, both for U.S. shows and also international. I mean, think about Squid Game. I mean, how many companies would have been able to have a Korean show wind up being this cultural juggernaut and phenomenon? But Netflix is finding a way. Now Netflix is also diversifying. They're moving into games more aggressively, live sports and sports entertainment. WWE Raw is coming to Netflix early next year. You think of things like Drive to Survive and their golf reality show and Quarterback. I think they're going to be doing a new show for NFL receivers this fall. So it's not necessarily all about live sports, but people that like to watch live sports probably also like to watch these sports documentaries. So, Netflix has done, I think, a good job of expanding the types of content that it shows.
Do they still view, I know that, a decade ago, their CEO had said, look, one of the biggest threats to us is video gaming and things along those lines. I know they've rolled out some gaming options, that might be tied in with some of their shows and things like that. But are there any signs that they're really focusing on trying to broaden out what they're doing on that side, if they still view it as a threat?
Yeah, they are expanding gaming, and I think that Netflix still would say that they view gaming and other forms of entertainment as things that could cut into the amount of time that people would otherwise be staring at their TV or mobile device to stream shows and movies. So Netflix realizes that they can't all be about content in the traditional form, i.e., a static TV show or movie that you just sit and passively watch. There are a lot of people who want to be a little bit more active with their video content and playing games, and Netflix is going to do more to try and take some of the market share, I think, from rivals in that area. And keep in mind also that Netflix also never really was a company that viewed itself as an advertiser-friendly one. They always kind of pitched themselves as a place where you can watch content and not have ads. But guess what? Advertising is still around, so Netflix has an ad-supported, cheaper plan, and people are flocking to that tier as well. So that's an area of more growth.
Very good. Paul, appreciate you joining us. Thank you so much. Have a great weekend.
You too, guys. Thanks.
That is Paul LaMonica from Barron's talking about Netflix. Mike, what do you got for me?
I've got a story about the upcoming big event on Monday, which is the
Tax Day?
Boston Marathon.
Oh.
No, not Tax Day. And kind of an embarrassing story for the Boston Marathon and the Boston Athletic Association, in my opinion. Here's what happened. 2014, Rita Jeptu won the Boston Marathon. She was then, in 2016, disqualified from the Boston Marathon because it turned out she was doping. They called the new winner, who was from Ethiopia, Buzanesh Deba. I'm probably butchering your name, so I apologize. And told her, hey, number one winner was disqualified. You are the new number one winner. And as I'm sure she knew, $100,000, $75,000 for the win, plus a $25,000 bonus for breaking the women's course record that year, which still stands, by the way. The Boston Marathon and the Boston Athletic Association, 8 years later, has failed to pay her a penny because they haven't been able to recover it from Rita Jeptu. That is not the winner's problem. That is the Boston Athletic Association's problem, and you need to pay the winner of the Boston Marathon. And I don't know how much the Boston Athletic Association makes on each of these marathons, how profitable it is, if it's even a for-profit entity.
I can tell you. So it is, I was pulling this up, actually, and they are a tax-exempt nonprofit entity. They're set up as a 501c3. Their revenue in 2022, which was the last year that the marathon returned to normal, was $43.6 million over the course of the year. Prior to that, for much of the 2010s, they were between $15 and $20 million in annual revenue.
So I know many don't take the sport of running marathons that seriously. This is embarrassing. And frankly, you shouldn't be paying out new winners until you pay previous winners their winnings.
I mean, imagine if you got the Masters going on right now. Imagine if they just didn't pay Tiger Woods from 2019 until 10 years from now.
What an embarrassment.
You know, it's, if you put on a contest,
pay the winner.
You got to pay the winner. Even if, like, there's mitigating, extenuating circumstances here, you should have that money put aside. Let's take a quick break for the entire weekend. Have a great weekend.
Happy
See you
Patriots
back here
Day.
Monday on the Financial Exchange.